committee and board meeting of the Falkirk Fund. We're on a tight scale this morning, so I'm not going to waste any more time. I'd like to introduce you to David Hickey. Now, David, as he's been saying, is becoming quite a personality, let's say. David is the manager of Lothian European Equity Portfolio. He is also leads the fund's work in responsible investment. So he's very, very much placed this morning to give us a briefing before we go into our own personal debate on what's on the agenda this morning. First of all, I should have asked, has anyone got any sorry folks, having a problem here. Is there any declarations of interest? Apologise. Nope. We'll move right on then and we'll hand over to David. Thanks, David, and thanks for your time this morning because I know it's very precious.
Convener, is it okay if we just do apologies at the start as well? Just for the record.
Yeah, apologies.
Yes, I have some apologies, Convener. We have Andy Douglas from Unison, who's on the committee. From the board, we have Ed Morrison. Simon Hunt will be late, but should be here. Tony Callery from Unison, apologies, and Sandy Harrower from Unite and UCAT has sent apologies.
Okay. Everyone? Thank you. There's quite a few your trade union reps missing this morning, which is one of these things, let's say. Okay, moving on then, David.
Thank you, Convener. And yes, with COP26 on the horizon, much news around it suggests that our trade union representatives are very busy at the moment. Yeah, I'm very much looking forward to our trade unions getting everything sorted so that our delegates may be able to get from Edinburgh to Glasgow and things like that, because we're all looking forward to hopefully massive amounts of progress at the Glasgow conference. So I'm going to take the note as read and just add some extensions to it, if you don't mind. People probably think that I hate, decarbonisation suggestions and papers and having to go over them again. But I actually very much welcome these sorts of things because it gives me the opportunity to discuss with you as passionate about. And I think one of the things that I can say with confidence is that we are united as a group, that our aim is real world decarbonisation as a key goal of outcomes from the pension scheme investments. Now, from my point of view and from the point of view of the responsible investment community, the consensus is that the way to do this is through engagement, working with the company, rather than blanket divestment. I'm going to give you an example of why we believe that is, and it's all around how capital flows through the economy. There are two kinds of investments, essentially. There are primary investments and there are secondary investments. The primary investments take the form of many things. We do infrastructure where we provide new capital to projects. We can buy new equity issuance on the market in an IPO or initial public offering, or we can even subscribe to equity offerings by our underlying companies. We can also buy bonds, new issued bonds in the stock market. I was speaking to our internal bond manager Ross this morning, who is bidding on a current gilt auction. So that provides new money into the market. And then there's secondary transactions, and these are actually the bulk of transactions that we do as asset owners. And these are transactions that are between different in the capital markets. So if I want to buy or sell an equity share, I would be making that transaction with another party in the market. So with a primary transaction, you're making a transaction with the recipient of the money, with the beneficiary of the money. So you're putting money into companies and projects, brand new money, to allow them to do their business. With a secondary transaction, I want to buy some Tesla, you know, I want to sell some Unilever. I buy my Tesla from someone else in the market, and there is no impact on the capital of that. The same way as if you bought a house that currently exists, no money would flow to the original builder. It's the same in the secondary market. So divestment doesn't withdraw capital from the company, which is why we see that engagement with the company and working with those companies to change the way in which they do business is the main means of altering the paths of those companies. Now, it's hard. I've got to admit, it's hard. You know, we're on the verge of a giant transition. You know, we're talking about net zero 2050, 2045 in Scotland. You know, that transition is going to be immensely difficult, and we're in the very, very early stages of it at the moment. And it's going to take bravery and nerve to work with our investee companies to help them through this transition, but only through helping our companies through this transition will we deliver that real world decarbonisation that we're looking for. Because divestment, although it greens your portfolio, it doesn't change the situation in the world. And we're looking at real world change. Now, I mentioned before we went live about events I've been at in London this week, and I've been working with the Transition Pathway Initiative on a new centre for close out with this and try and play a video to you. If I can get the technology to work, I apologise in advance if it doesn't. But within our collective statement of responsible investment principles that is shared between Falkirk, Fife and Lothian, we specifically mention using the Transition Pathway Initiative to assess the transition plans of the companies that we hold in our portfolios. Now, there's been concern about this from members before because there's only 400 company announcements on Tuesday around extending that from 400 to 10,000 companies. And that tool is going to be one of the key tools in assessing how well our companies are transitioning and how we might influence them even further to accelerate. So I'm going to share this video, and the people who belongs to you might be able to spot. Sounds on this. So you can hear it.
The Transition Pathway Initiative is the leading global tool for investors to assess and therefore address the impact of investors' portfolios on our climate. When it launches in a few months' time, the TPI Global Climate Transition Center will become a key pillar in the sustainable finance architecture emerging out of COP26. It will literally change the conversation.
This is about the head and the heart. The head telling us that the science says we must get climate change under control, and the heart setting out very clearly the moral leadership. 2 weeks from now, less than 2 weeks from now, we'll all be meeting in Glasgow, and it's trying to build consensus so that we can limit global warming. And of course, governments can make all sorts of commitments, but ultimately, a lot of this has to be delivered by companies, by what I call the real economy, and by our friends here, the financial services sector. This initiative is representing about $50 trillion of assets. I mean, these are huge numbers. And what we now need is to get this money deployed also in developing countries.
What is being done through this seems to me to be the most important transition to action from good intentions of anything that is happening in the financial world today. It will enable companies to be held to account, but also to demonstrate that they are doing things properly without the suspicion that they're fiddling the figures, because it's objective, it tests them, and it's measurable by the market. We want companies to change their actions, not merely to hear our words.
My challenge to all of you in this room today, and many of you are doing this already, is to make sure that you're thinking about preparing for climate shocks, but also nature's recovery as you think about your assets under management.
Okay. So hopefully you all heard all that. Yeah. So as the COP President Alok Sharma mentioned in that this actually covers, it's not 50 trillion, it's only 40 trillion of assets that are committed to supporting the Transition Pathway Initiative. And it's through things like this that small funds, this Transition Pathway Initiative was a joint launch by the Church of England Pensions Board, a 4 billion pension fund, Environment Agency Pension Fund, which is now part of the Brunel Pensions Partnership, another 4 billion fund. So these are funds that are similar in size to us, but through this responsible ownership, are able to build much greater coalitions and have huge real world effects on how we manage the transition. And I've been very much privileged to be part of that. And through the assets that your management kind of give me to speak on behalf of, and that, you know, sharing that, I think the Archbishop used the term moral imperative, that we can members as well for our communities, and that's down to responsibly manage those assets. But if we turn our backs on all fossil fuels, all problem climate companies, we lose our ability to vote, and we lose our ability to hold those managements to account. There are going to be many questions from you, so I'm going to leave it there and ask if Brian or Bruce have any further comments, and if not, open to questions. Convener, back to you.
Thank you, David. Brian, would you like to come in?
Adana, on the basis that I'm going to run through the report,
Okay.
I'll leave it till then. But much of what I will say will chime with what we've heard from David.
Yeah. Bruce, have you got any further comment at the moment?
No, nothing to add. I think Brian's got a lot of detail in the report. Yeah.
Okay. And we've got Scott and Stan here as well this morning. So that's great. Okay, Brian, would you like to go through the report, or is there anybody wanting to ask David any questions at this moment in time? Nope. Okay, we'll move on to the agenda item, and that's with you, Brian.
Thank you, convener, and good morning, everybody. This report has been triggered by representations made by the two largest employers in the fund, and those representations are captured in the appendix to the report. As David has touched on, COP26 in Glasgow is clearly a highly topical backcloth to our debate and discussions this morning. Convener, I'll look to draw out the main points in the report. We have behind us David, who is a specialist in this area, as you've heard, and will be able to assist and contribute to questions and points in the discussion that will follow me running through the report. But I think at the outset, we need to recognise, or should recognise, that this is a complex matter. It's all often presented as something very simplistic and straightforward. And my suggestion is that it's far from that. And hopefully the report and the points in the report will help demonstrate why that's the case. Convener, I would suggest that the fund's objective and that of those advocating divestment are ultimately very much aligned in terms of achieving a more sustainable world with lower carbon and emissions. Where we differ, I think, is on both the practicalities of immediate investment, where we really do need to confront the reality of current and certainly near future energy needs, and the reality behind that of a transition period. And also the second point is on effectiveness. And again, David was looking to make that point at the front end of the meeting. Divestment achieves very little, if it achieves anything, in terms of actually making a difference. And I think that's the essence of the point. What's your objective? Is it to make a statement, a gesture, or are you actually looking to make a real change on what's happening on the ground? And I think that's a fundamental question that each of us need to ask ourselves in this debate. The Falkirk Fund's approach to responsible investment is set out in the bullet points at paragraph 4.3 of the report. And just maybe to draw out a few of them, you can see for yourself them listed there. But the first one, and probably the most fundamental one, is about engaging with companies. We're looking to achieve a fair and just transition to this necessary new environment. And to help do that, we're also directly investing in low carbon opportunities. And later in the report, we'll pick up some specifics on that. And we do already have divestment on the table as an option. And we will harness it. And again, we'll say more about that or see more about it later in the report. If a particular company we invest in is playing at this, shows no real appetite and willingness to actually effect change after having heard the representations made by shareholders such as this, then ultimately we will divest. So it's not as if the fund stance is divestment is completely off the table. It's just blanket divestment has questionable value. That's the fund's proposition, and indeed the proposition of most funds. There are 80 funds in the Local Authority Pension Fund Forum, and that amounts to quite a few bob in terms of investment and investor leverage. And they are all signed up to this approach, this agenda of constructive, positive and effective investment with companies, engagement with companies. The report, as you'll see, is structured into several sections, and I'm just looking to go through each of these sections and draw out some of the content in each. I'm not going to go through everything. So the first one is on context. And maybe if I jump to para 4.7, and you'll see there an extract from the fund's statement of responsible investment principles. And that paragraph quoted there captures the essence of the fund's position. And you can see there explicitly that reserve position of the capacity to apply divestment as part of the toolkit. The following paragraph brings in the linkage, an important linkage with employer contributions, to the extent that there's a shortfall in investment returns. It's ultimately the employers who pick up the tab. And I can't imagine there's a single employer in the 30 or so that are in our fund that are not facing financial pressure at the moment and would not welcome a flow through of an impact onto their employer contributions. Para 4.9 just touches on one of the practicalities around divestment, and it's drawing the distinction between the range of direct shareholdings that the fund has in what we might term fossil fuel companies, which we'll come to in the paragraph after this 4.10. But the fund, as all funds do, hold a fair proportion of their investment in index funds. And that essentially means you buy the whole index, FTSE 100, whatever it may be. And inherent in that range of companies will be such companies. So you don't have the same direct control or leverage in those instances that you do where you have direct shareholding. And just flowing through to that point, there's something of a double-edged sword here in para 4.10. That para notes that at the time of writing the report, the shareholding in the fund was some 50 million. And that was mentioned because one of the lines of criticism was and is the proportion or the value of shareholdings in such fossil fuel companies. So one side of dealing with that is the counterpoint. Well, okay, we do hold these, but they're only a tiny proportion of the fund's overall value, 1.5%. But actually, in practice, since that figure was included in the report when it was drafted, the value of that 50 million in those companies has risen to 65 million, some 30% increase. So from a critical point of view, okay, that adds more leverage to the proportion, albeit still tiny, of the fund held in such investments. But the rise in value shows from a pure investment point of view, and given the ultimate purpose of the fund, which we'll come on to shortly, the merit in, at this time, holding such stocks. So it is a double-edged sword argument here. If we move on to the next section of the report, dealing with legal considerations, and I think at the outset, just to make clear, the committee has clear, the decision-making body, the committee, Falkirk Committee, has clear quasi-trustee responsibilities in this respect. And the board has as its primary purpose the monitoring of the committee's adherence to the regulatory environment. So both committee and board have fundamental interest and responsibilities in terms of legal responsibilities here. And this section in large measure draws on the most contemporary legal opinion which was obtained by the Scheme Advisory Board and consolidated and reinforced and reaffirmed a range of previous legal opinions and capturing significant cases that were relevant and highly topical at the time. I can remember the Edinburgh Council case with Martin in terms of holdings in South African companies at the time of apartheid, when that clearly was, and rightly so, a major issue. And latterly, during the miners' strike, a major landmark case with involving Arthur Scargill as leader of the miners' union in terms of the trustees' responsibilities in terms of trying to skew where investments were taking place. And that first paragraph here in 411 centres on the purpose of what a pension fund is there to do. If we just roll forward in that section, particularly perhaps 414, which really captures the essence of it, where it's highlighting that a decision to sell assets or divest, where it's made on non-financial grounds, such as climate risk, it should be done on a case-by-case basis rather than across the board. And given what I've already said and that reference to the Statement of Responsible Investment Principles, that's precisely what the fund is doing. It's dealing with each case, each company on its own merits, rather than seeking to take a blanket view in the manner that proponents of blanket divestment would have us do. The next section takes us on to, again, a core consideration. Is divestment effective? Is it going to help achieve what you as an advocate of divestment might want it to achieve? The first paragraph in that section picks up in the series of bullets there, the sorts of areas that are problematic, that you need to have an eye on in considering what a company is actually doing in terms of making a difference in this environment. And maybe the last one, the last bullet there, additional disclosures, is a key way going forward, because one of the difficulties in holding companies to account is the inadequacy, both quantitatively and also qualitatively, in terms of the information that's made available by companies. It varies greatly. There are some, I think, good examples which David no doubt would be able to highlight, but many companies fall short here. And there's also the added difficulty that there isn't yet a definitive reference framework. An obvious parallel is, say, with accounting, where there's a clear set of standards and reference points. And that's certainly an area where development does need to take place. I know on one of David's recent podcasts, there was mention of some good progress being made here in the oil and gas sector, and that needs to ripple across other sectors as well. Paragraph 418.1 picks up on another core point, and it was a point David emphasised at the front end of the meeting, that by divesting, you lose any control, any influence, any leverage you have over a particular company. And in all probability, your share will be sold on to another party, possibly a private equity entity that has no or little public accountability, or a sovereign wealth fund who do not have perhaps climate change as one of their primary interests. So, and not a thing has changed. As David was saying, this distinction between primary and secondary investment, where you would make a difference is investment that's new and perhaps going into problematic areas. But those shares we're talking about here are just transactions between two parties. We hold them in the fund, we sell them on to XYZ sovereign fund or ABC private equity company. Makes no difference to the company other than a change in their shareholder register. It doesn't make one iota of difference. And because you're losing the influence and leverage, it's probably a diminution in the effectiveness of moving in the right direction. 418.3 just picks up the point that there is evidence that these companies are transitioning, and there's a few examples given in that section, and also noting that they very much have the technical and project skills that are so much needed in the transition to renewables as well, and can be harnessed. 418.4 just touches on the practicalities, and particularly for us in Falkirk, with the major complex in Scotland, Grangemouth, on our doorsteps, and the linkage with jobs and the economy, and the proposition that what's needed is a managed transition to a new environment. And INEOS down at Grangemouth are and have made significant changes in their operation down there, consistent with this agenda, notwithstanding INEOS are a private company, they're not a public company, so there's no shareholding leverage, but they're doing it anyway. I think 418.6 is an important one, as a front end of the report makes the linkage with the Stirling representations here. Essentially recognising that climate change is a challenge and a problem much wider than fossil fuel. One strand to this is the range of other sectors that contribute to climate change, major contributors to climate change, transport, agriculture, etc. But also, on the flip side, having regard to the very real environmental and social risks that emerge in pursuing a renewables agenda in terms of issues around mining, etc. So there's implications and consequences on every avenue you take here, and I think we should continually remind ourselves of the need to take a rounded and balanced review. It isn't binary. The last point in that section is not an argument against divestment in itself. What it's seeking to do is just draw the attention of decision makers, i.e. you, to wider potential implications in terms of precedent of potentially adopting a divestment stance we're talking about climate change today, and quite rightly so. But at various points, there are other highly topical areas that emerge in similar terms. Tobacco, armaments are two ready examples, but they're not the only ones. And, you know, if you think the thing through, if you took a blanket divestment policy, notwithstanding the arguments, counter arguments and points in this paper, and then rolled that forward to tobacco, armaments, alcohol, you know, where do you draw the line? Your investment universe shrinks, and it takes you back to the point, what's the purpose of the pension fund? And that purpose needs to be at the heart of those considerations. The final section, convener, actually is looking to capture a lot of the good, positive, constructive and effective things that the fund is already involved in. And the first bullet there is a very topical one. Literally in the past few months, we've made 150 million direct investment in an environmentally themed mandate with PICTET. You can see from the paragraph the sorts of environmentally friendly areas that it's investing in. Previous investments are set out in the next bullet point. We're involved wind farms, solar parks, hydroelectric schemes, waste to energy, and other areas listed there. So there's a whole portfolio and array of areas where we're actively investing in renewables. The first paragraph over the page, at the top there, page 9, picks up on the wide and expanding range of pressure investment groups. David talked earlier about the Transition Pathway Initiative and adjusting from 50 billion down to 40 billion, trillion, sorry. There's a few zeros missing there. Trillion leverage, that's serious, that's weighty, and that brings influence, that brings change, and we're active in them. We've also been active and stuck our heads above the parapet, so to speak, in terms of resolutions which we've signed up to with respect to climate matters at the AGMs of, you know, big player companies, multinational companies such as Barclays. And we also, all our investments, whether it be external managers or through the expanded portfolio with the Lothian in-house team, all these managers screen their investments for environmental consideration before investments are made. They're not made blind. They're made by people who know the market and know the issues and are capable of balancing the risk-reward equation there. Rounding off that section, convener, para 422 is a recognition that the fund continues and needs to do more. And one way that we're suggesting, and indeed this particular point is picked up in the recommendation, is to deepen our ability to track and monitor, and on the back of that, hold to account those companies that we directly invest in, and ensure that actually what they're doing on the ground is not just talk, it's walk, that they're actually making real change. And it does chime with my earlier comment about the need for companies to expand their disclosures, and also for there to be an emergent and an evolvement framework of standards and reference points that will then help hold those companies to account. So this isn't a snap of the finger overnight thing. This is a direction of travel that we will look to harness and expand on going forward, along with the new specialist engagement company, Hermes, that we've recently recruited along with Lothian to help us engage with companies. So, convener, I've spent a bit longer speaking to this report than I would normally do, but I think it reflects the significance and importance and complexity and indeed emotional interest in the subject. And I would just round off by saying that whilst the committee and board clearly need to have regard to their legal responsibilities, and they are real as set out in the report, I would suggest that even leaving that to one side, the case for the fund's stance, essentially of robust engagement, is well made by the other factors set out in this report and reinforced by David's presentation at the front. So, convener, I'll stop there. We'll obviously come back to the recommendations in due course, but I'm sure there's plenty scope now for debate and discussion and questions. So I'll stop there, convener. Thank you.
Thanks, Brian. And it is a very emotive subject. Some of the examples you gave as far as firearms and tobacco and various world issues over the years is acceptable, but this is obviously an issue that's affecting the whole world. It's global and it's imminent, as we're told, whether you believe that or not. And it's something obviously on everyone's minds at this moment in time. So we're looking at something that we've never had to look at before. It's not something that's happening in a country. It's not a particular industry that we just don't like. It's having an effect on our world as it is at the moment, and it will have an effect on our future. And for me, protecting a pension that's not able to be spent in the future because there is no future is something that we really need to bear in mind. And that's why this is very important. And it's a very serious subject that we'll have to discuss here, and guiding the fund through that is the best way possible, but with the best intentions as possible is paramount. I was thinking there about the wee video that David showed, and the fact that the confidence in politicians is at an all-time low as well. And I appreciate that it's an absolute imperative that David, yourself and others in your profession need to be right in there guiding these politicians. So you have a huge responsibility on your shoulders, as we do all have. But I would like to bring Mary Claire in just to let you know. Mary Claire is in our committee and board meeting this morning. Mary Claire is the Climate Change Officer within Falkirk Council. Mary Claire's been leading quite a few training courses for us as councillors and as managers within the council. And I'll just bring Mary Claire in now.
Thank you so much, convener. And hi everybody, it's really nice to meet you. As Adana said, I lead for all things climate change in Falkirk Council, including like divestment or research into it. I want to first of all state that I am not completely for, like I don't know what my opinion is yet on divestment, so I come in peace. I'm not here to preach at you all. I have genuine questions that, and I spoke to Brian earlier to say like I'd be really interested to speak in this forum and just see what you feel. as you can imagine, within my industry, there's a lot of research into this particular topic, and it is really emotive. It's something that people want to do the right thing, but at the end of the day, they still want to get paid, and they want to have a secure future, and that's something that we all do. And that's why I caveat it with, I don't know my opinion yet. So what I was going to do was just ask a couple of questions that that I have relating off of the research and the things that are being said within my community, just so that, again, so that I believe it's something that I completely agree with Brian and David. I don't think it's a blanket approach. I think it has to be, as everything really has to be bits and pieces. But yeah, if you will indulge me to ask you a few questions. So the first one I really have relates back to by being with these companies, you have influence to you know, you have a seat at the table to influence what they do and say. A lot of the research that I have covered on this topic is quite strongly indicating that actually the only benefit, and so I looked over the last 10-year period and looking at and again, I apologise, I'm not a financial expert, but looking at the FTSE 100 companies and the MSCI, it was found that over the last 5 years in particular, the only quantifiable benefit of that approach was greater transparency in the companies that derive fossil fuel, but there wasn't actually a change in their behaviours. And that the recommendations of the reports that I've read are that if you're going to look at influencing or changing, that's appropriate, but only when you have the ability to change the actual business model of the company. And it was termed that fossil fuel companies, to be able to have the kind of influence that point suggests, you're really actually talking about convincing these companies to either switch to a different mode of working or to retain 80% of their assets in the ground, which means that for that particular company, you become asking them to do something that kind of cuts 80% of their outputs. So again, it's just to see, like, what, you know, if you came across that point and what you would say to that, again, so that I can have a educated discussion with people on that. The second thing I wanted to just ask surrounds fiduciary duty, and there has been a legal precedence where pension companies have been taken or have been subject to a legal challenge from younger members of pension funds, where they do not want to have their money contributing to a factor that they see will affect them disproportionately to older members of the pension pot. And under the terms of fiduciary duty, we have a duty to make sure that our investments are kind of ethical for all members within the pension pot, and that you can't, sorry, that's just for anybody that doesn't know what fiduciary duty means, and apologies, I'm teaching my granny to suck eggs. And so around fiduciary duty, like, we have a law, we understand only from our job in our organisation, there's a lot of younger members of the pension pot that are really concerned about that. And again, harking back to the point that, sorry, I don't know if it was Brian or David that made with regards to where the pension pot's related specifically to the Indus. But again, FTSE 100 and the MSCI of late have offered the ability to mirror the FTSE 100, but they remove or eliminate fossil fuel companies. So you can still invest in FTSE 100, but it just takes out those bits. And that's why I think, like, again, maybe the partial divestment is a better idea rather than blanket. And I know that that's what the Environment Agency have done. And then the last point was really around what's your opinion on the comment that by investing in fossil fuels, you're actually potentially investing in stranded assets, and that come a few years down the line, well, in fact, it's not even that. So again, a lot of research and a lot of papers have tried to quantify and compare investments in fossil fuels against investments in renewable companies. And there was a paper done by the Transition Economics and Platform in 2020, which demonstrated that UK public pension funds who invested in fossil fuels collectively had actually fallen by 2 billion in less than 4 years, and that was the only time in recent years that local authorities, and because again, because I work for the local authority, my research has focused around that. But it was the only time in recent years that local authorities' pension investments have actually lost their members' money. And that was due to fossil fuel investments losing their value. So yeah, there's further details there, and I can send you what I've got so you can see what I'm talking about. But that's the gist. So it's just to find out what you think on those points. Thank you.
Okay, do you want to come in, David?
I'll come in on that. Marie-Claire, fantastic set of questions. I'll probably start with the easiest one first, the fiduciary duty thing. I know the legal case. It was brought against Aussie Super or one of the Aussie Super funds in Australia. It was a DC scheme, defined contribution scheme, not defined benefit scheme, where the underlying investor wanted to have a say on where they invested their money, because when you're a defined contribution scheme owner, the risk, you take personal risk on the outcomes, as it were. Whereas in a defined benefit scheme, you get a defined benefit. So you actually have no underlying risk in your portfolio. It doesn't matter, you essentially have a right to a cash flow from the fund. It's not so much an investment pool in your defined contribution scheme. So the structure is somewhat different, and therefore the way the risks sit is somewhat different. And I'll maybe allow either Brian or Bruce to come in on that later. But I'm going to go through your other questions, because they are fantastic and absolutely the right questions. So I'll start again with well, a few of the rest are kind of linked together. So on your indexes, FTSE 100 is 100. That is the index. What you can do is you can have different indices that kind of tweak that. And that's something that actually, while I was down at the London Stock Exchange on Tuesday, I was speaking to Aled Jones, who is one of the heads of indexing, about the TPI aligned index that they run, and around new indexes that are more aligned to Paris aligned benchmarks and transition alignment in general. So these involve tweaks to that, and may well be a more suitable benchmark for the fund. That is certainly some work that we're doing at Lothian at the moment, and that work will feed into the next strip, which will go to both Falkirk and Fife for, are the benchmarks we're using the correct benchmarks? So yeah, these are good questions. And do you divest entirely from sectors, or do you change your weightings to change your risk? And that's all stuff that we're looking at, because we do have to, as Brian said in one of his final points, we have to keep up with this ever-changing landscape of what's happening and really be on top of it. It's complicated and difficult. So the bit about stranded assets and your very first question about seat at the table kind of linked together. So the research that you quoted suggests that there's not been a massive change in behaviour over the last decade. And I would agree with that. I think that over the last 18 months, 2 years, with things like Climate Action 100, we're beginning to get some momentum. And we are able, as investors, to feed into the transition plans of these companies. Now, Brian mentioned my my podcast. The last podcast, we talked an hour with experts from the London School of Economics, and from TPI and the Institutional Investor Group on Climate Change about the fact that we don't know what a good net zero transition plan looks like yet. We're all working on this together. So it's, do we work on this within the room and have a seat at the table while we work with that? And the companies are inviting us in because they genuinely, they're struggling with this as well. So it's up to us to kind of support them through that and actions that would be acceptable to our stakeholders. Now, you talked about moving to a new business model and leaving oil in the ground, and that, you know, they're maybe not going to do that. Well, I'll be honest, that's exactly what we're asking them to do. This idea of stranded assets, the assets that are producing at the moment for many of these companies are going to keep producing until those assets come to the end of their natural life. An oil field lasts 15, 20, 25 years generally. And we're still going to be using lots of oil, whether we like it or not. We can be using lots of oil and gas well into the late 2030s, early 2040s. You know, even with the EV, the ban on petrol and diesel cars coming in 2030, you know, the stock of fossil fuel cars, ICE cars, internal combustion cars, are going to be still running well into the 2040s. You know, how many people do we know that has a car more than 10 years old? Quite a few. But what we're asking now is that where those companies put their capex, we spoke earlier about primary and secondary investment. Well, capex or capital expenditure is what the company invests in their own business. So that's a form of primary investment. You know, are we investing in wind farms or are we investing in new oil exploration? And what we're saying as investors is that, you know, most of these companies, it's you have production assets. We need to see those assets run down, and we need those capital flows either to be returned to us as shareholders through the form of dividends, so that we can reallocate it into new areas, and or the company reinvests it in the new areas, in much the way that Ørsted did when they transitioned from Dong Energy and actually didn't close their oil operations, actually sold them to INEOS, so into private hands. And we have no say in how INEOS run that because they're a private company. So there's an argument there to make sure that they don't divest those assets into private hands so that we can still keep an eye on what they're doing, and that they're run down and that the lives of those assets aren't extended so they don't remain stranded. We're not putting a lot of capex into those, and we're managing this transition to a new economy, this transition that is starting now. And you know, it's a 25-30 year process. So that's kind of where we are. I think that touches on most of the points you made, Marie-Claire. I'm going to hand over to my fellow speakers, Brian and maybe Bruce, if you have anything to add to any of that.
Convener, I would defer to others on those points. I would agree that the 4 questions from Marie-Claire were excellent questions and well made. But I wonder, we have Bruce, but we also have, I think, I'm just looking at my screen, certainly Stan Pearson, one of our advisors on the call. And I wonder if either Bruce or Stan or Scott, I think, sorry, Scott, you jumped around my screen. I thought I'd lost you there. Scott Jameson and other advisors here. And I know they may well wish to complement the points that David's already made. So I'll withdraw and leave the floor to others, Convener.
Okay, thanks, Brian. And thanks, David and Marie-Claire. Right, guys, I'm in your hands. Who would like to come in? Got Bruce, Scott, and Stan.
Shall I make just one comment? You know, addressing part of Marie-Claire's questions, and it just is this idea that business models evolve, and yes, I think you know it's critical to note that business models are evolving, And I'll just take the example of, you know, BP being a big, well-known energy company, and you know they are, you know, they're very aware of the change. You probably remember one of their old slogans was "Beyond Petroleum," and you know, if you look at the financials of the company, you know, it's roughly a 90 billion pound company in the stock market, and it's investing something like 4 to 5 billion pounds a year into renewable energy assets. Now, if it keeps doing that for the next 4 or 5 years, it's going to have an invested capital base in renewable energy assets of 20 billion pounds, which will make it one of the biggest, $20 million, I should say, which will make it one of the biggest renewable companies in the world, probably. And so we have to think, you know, down the road, they may be shrinking their oil and gas exposure and expanding the renewable assets. And at what point does that company become an investable equity? If you argue that it's not today, will it become one? And I think there's a fairly strong argument that it will be one. Come on. And the second point is just simply about investments and the returns that we need to generate for the funds. There is a price for everything, and you know, it's quite possible that these types of assets, stranded assets or otherwise, become, you know, deeply undervalued, and renewable energy assets become extremely overvalued, and there's no return available for us to generate in the pension scheme, which certainly wouldn't help us to pay pension funds. And you know, if we look at BP today, if you know, at a $75 per barrel of oil, and it's about 82 at the moment, BP produces $15 billion of free cash flow, which is being returned to shareholders via a 5% dividend yield, and they're also doing a 6% buyback and paying down debt at the same time. That effectively is a 16% return for investing in BP. So you know, we have to look at whether we can generate returns, whether they're stranded assets or not. And even with stranded assets, that possibly ticks a box, and that you can see why investors would want to invest in that type of company, even as they wind down their oil and gas assets over the next number of years.
Can I come in, please?
Yes. Yep.
Scott. Some general points, if I may. And the first one is really to ask you a question rhetorically. Who's the bigger villain, Shell or the person who drives into Shell and fills up their tank? The focus is very much on Shell rather than on demand. I personally, with regard to the question of, philosophical question of divestment or exclusion, I very strongly have the view that that's an appropriate portfolio approach if you are happy for that business to shut down tomorrow. And that would apply to tobacco, to nasty weapons manufacturers, gaming, etc. But if you were to apply that approach to oil and gas, then I wouldn't need to worry about driving into the Shell petrol station. There would be no fuel to run the world. The world economy would collapse. We certainly wouldn't need to worry about the climate problem, but the mankind would disintegrate long before then. And if you don't believe that having divested, it's the equivalent of expecting the company to cease trading tomorrow, then you're essentially just passing the burden of kind of ushering in change, transformation to somebody else. It's an abdication of responsibility rather than an act of responsible management, in my view. So I would very much, and I'm very much in favour of electrifying everything, but I live in an environment where there is no recharge electrical charging set up, and even if there was, the grid can't charge everybody's car here. So let's recognise that there are two sides to this. There's the supply side, which is easy to point the finger at, but there is, for every oil barrel produced, there's a barrel of oil consumed. And I see nothing with any of the large investment funds that I interact with. I see nothing where they're spending anything like the effort forcing invested companies to reduce their carbon consumption in the way that they focus on pointing the finger at carbon production. And the sooner we recognize that there's a balance on both sides, the better. But if you focus on cutting production, you get economic collapse. If you focus on consumption transformation of energy, then it's a much more constructive world for everybody. And that would include the oil companies as well, who would recognize the shifting sands of demand and shift their business models accordingly. So I'm all for decarbonising, but I very strongly have the view that this focus on eliminating production is frankly suicide in an economic sense. Better we focus our efforts on reducing demand. So a bit of a sermon there, but I think this balance between supply and demand is very important.
Thank you, Scott. Stan, have you got anything you would like to add?
Yeah, there's quite a lot of moral questions involved, and there's a clear urgency about things, but I'll try and echo quite a lot of the statements that have been made, including the questions that have already been asked, and focus a bit on it. Try to be purely from an investment perspective. So exclusion is quite a blunt instrument, and I would echo what Scott says about thinking about both demand and supply, because the fossil fuel industry doesn't actually generate that much emissions by themselves. It's their end products which are used by others, which generates all the emissions. So transport, agriculture, cement, construction, lots of things use these things, but everything else, fashion, everything else uses and emits carbon. So once you start excluding, where do you want to stop? And your investment universe shrinks as a result of that. In terms of reinvestment, Bruce has highlighted the fact that you can reinvest, and the question raised about business and market structures. All businesses have to change. They have to change the market structure. They have to change the metrics which they measure themselves against, which we'll come back to. So part of the transition is getting all types of businesses to adjust what they measure, what their incentives are, and what they do. But also at the moment, the reinvestment universe in the sort of green world, the sort of PICTE type investments that Brian highlighted, at the moment, a lot of these aren't directly investable, and it's a relatively small universe, and it's relatively expensive, all very relative. So if you wanted tomorrow to exclude all the things that are big emitters and big users of carbon and switch to purely, let's call them positive companies, it would be a very difficult transition to effect for a pension fund in both listed and unlisted assets, even if you put your whole energy towards it. So that suggests that any transition in this area is going to be painful. And market structures and what we're seeing in the current gas market demonstrate the pain that happens. That implies prices and valuations for your assets will be volatile, as we've seen in the oil and gas sector, but for lots of other things as well. And there have been quite a few companies, I can think of a few in Germany, like RWE in particular. The Danish company involved in oil has already been mentioned, both in the report by David. So there are quite a lot of examples of companies making quite radical changes to their business models. As investors, you have to decide how much you're willing to back them, but there is going to be pain, and there has to be a degree of maturity about you're willing to accept the consequences of your actions, and you're willing to accept the consequences of what you're asking the people who are investing for you, whether they're third-party managers or your own managers, about what to do. In terms of voice and participation, there's quite a lot of examples, and I would echo David's comments that gradually that seems to be getting more traction, and I think as more both voluntary information and data becomes available to quantify and set targets, the force of that participation will only get greater. But everyone's sort of groping around at the moment, trying to decide exactly what it is. An example of that in terms of how you measure things, just as Scott says, he's got a rule of thumb of would you want to stop the business tomorrow? For me, somewhere or another, we have to get effective carbon pricing. So the sort of stuff that the European Community is trying to bring in at the moment of pricing carbon, not only in terms of consumption, but also at an import level, where they're groping towards some sort of policy, albeit a bit slowly, is essential, because there's no point in us, the equivalent of divesting, if we only export all our problems to China, who then use coal-fired power stations to make the goods, which we then import, if we don't include that carbon tax at import level, rather than just our own consumption. Again, it comes back to the issue that was mentioned at the outset of, are you making an impact in the real world, or are you just coming up with metrics that make your portfolio look good, but don't actually change anything? So I think it's quite a complex situation of which there's no easy answers. And one plea I would have is just, you've got to accept for your managers what you're trying to achieve. So in general, I don't think you can get as good returns if you have exclusions in your portfolio. And I know there's been quite a lot of work done, but that's to suggest that you can get benefits. Yes, you can, but in terms of the sort of scale, I think there's it's trying to recognise that the transition that we need to be making is going to involve pain everywhere. It's just a question of where you want to take your pain, both intergenerationally and as different sort of constituents, consumers, pension fund asset holders and such like. So that's what I would advocate.
Thanks, Dan. I'm going to hand over now to the members of our committee and board for questions, for comments. Could please indicate by raising your hands if anyone's got any comment or question that they would like to make. Senior Councillor Blackwood.
Thank you. It's probably a question to David. I attended a training session recently when David spoke to it, and he spoke about local government pension funds through share ownership of companies have the ability to vote onto the boards, members, individuals of their choice, who can probably influence chief executives to look to change the direction of their companies. I wonder if you maybe, I don't recall you mentioned that during your speech. I just wonder if you could give me examples of how that operated.
Absolutely, Councillor. Yes, that was the Jeffy event that I presented to on their opening net zero roadmap presentation. When you buy a share, you basically get two things. You get the right to a dividend and you get the right to vote. And that right to vote extends to many things at company meetings, including the selection of directors. Now, there was a very big and unusual event happened earlier this year, where Exxon, who we're all very familiar with, Exxon have not been reacting well to our attempts to engage with them as a community of responsible investors. And there are various things we can do to escalate that. One of them is we run slates of independent directors so that we change their boardroom structure, and therefore our directors go on to change the executives of the company eventually. Because at the end of the day, as equity holders, we are the ultimate owners of those companies. So what we should say should. So with the Exxon engine number one thing, it was a very big collective effort by many Lothian Pension Fund, and by extension, really Falkirk and Fife, filed what they call a solicitation notice with the Security and Exchange Commission, and that allowed us to legally go out and lobby other asset owners to vote for those directors. Now, we had a slate of 4 directors who were far more progressive in their attitudes towards a low carbon transition than the current existing directors and management of Exxon. And we were able to get 3 of them elected onto the board. And I know that during those very big shareholders of the index schemes and stuff like that, the solicitation notice that we filed on behalf of our stakeholders was used as a reference point for why those index companies were voting the way that they did. Now, we got 3 out of the 4, and I'm going to quote Anne Simpson, who is the Chief Executive Officer at CalPERS, one of the world's largest pension funds, who said that had responsible investors not been divesting from Exxon in the numbers that they have already been doing, we would have got all 4 rather than 3. This is the new game that we're moving into now, and it's imperative that responsible investors are the ones holding the voting power and not the let's say less responsible examples that Brian gave earlier. And I'll close there. Hopefully that answers your question, Councillor.
Okay, folks, have we got any more questions or comments? No? Are people happy to go to the recommendations? Yep. Obviously, it's a very well written, informative report. The report does certainly cover our position as a committee. Is everyone happy to accept the recommendations within the report? Agreed?
Agreed.
Agreed.
Thank you. And thank you so much, guys, for your input this morning, and also to Marie Claire for allowing us to debate this and discuss it. Thank you.
Thank you, convener. I'm going to drop off now. Thank you, everyone, for your time this morning.
Okay, we're moving on to agenda item 2 on our special meeting. Just before we move on to the agenda item, I want to highlight, I think have we still got Jennifer on the call? We do have Jennifer. I believe Jennifer is leaving our board after many years of being on the board, and I've certainly appreciated Jennifer and her ability to zoom in on particular details within the reports over the last year. So Jennifer, I'd like to thank you on behalf of the committee this morning. Sorry to leave, sorry that you're leaving us, but I wish you well in your ventures going forward. So thanks, Jennifer.
If I could just say thank you very much. You've been a pleasure to work for as a board and have provided me with a lot of intellectual challenge over the years in a sense of understanding actuaries, to be fair, not my fellow board members or committee members. So I thoroughly enjoyed it. I will be replaced. The employee representative that's going to come on for SEPA is a young gentleman called David Morgan. He's not an accountant, but he is our sustainable procurement manager. So obviously he's hugely interested in this area and brings with him the ability to be very erudite on all issues sustainable. So hopefully you'll enjoy that that input and give him the support and general tolerance because I know I've sometimes overstepped the boundaries of a board member when I've seen the need, but I have genuinely found it very helpful, enjoyed my time working with you, and I actually genuinely miss meeting you face to face. It's been stuck on a screen is doing my head in as a dinosaur, but thank you very much.
Thanks, Jennifer. Good fortune in the future.